Hello, listeners, from Roy Demarev in Sam. Now, last week's broadcast seems to have gone wrong because the radio played the previous week's recording rather than the one I'd made specifically for last week, in which I dealt mainly with the issue of the possible or forthcoming trade war. I also mentioned something about Russian history, and I'll start this week's broadcast by recapping that. It's a sort of trailer of a report I intend to make to you. Well, it might take a few weeks yet because I have a very big book to read, a book by a man called Eric Hursley, who has written a book on how the East was won as distinct from the West. We all know about how the West was won with the caravans and the cowboys and the soldiers and the Indian wars and so on, but we know very little about how the east of Russia, that is Siberia and beyond Siberia, by the way, which was won by Russia during the Tsarist period. And by way of a trailer, I'll mention to you that it was won basically because of fur. Would you believe it? It wasn't gold they were chasing, it was fur. They were trapping animals and taking the fur back to Moscow. This is in the middle of the 16th century and going on for at least 100 years. And they made a fortune that way, in the way that people that found gold in the West, in the United States, made their fortune. And these trappers, they got to the east of Siberia by river. The rivers run north and south, but they built wooden boats which they could actually dismantle and rebuild on the next river over as they moved further and further eastwards. And the people that actually built and ran the boats were sailors. They weren't the trappers were their passengers. Now, the whole basis of occupying Siberia, taking it even beyond Siberia, was very different from the situation in the west of the United States. The interaction with the indigenous people of Siberia was not particularly charming, but it wasn't quite at the level of having the wars and massacres that we know of from Western history. Anyway, you'll have to keep listening if you want the rest of the story, which I'll have to develop after reading Eric Hursley's fine book. So back to our current worries. What is the main worry at the moment? It is that a trade war is developing. And I warned of this even 2 or 3 weeks ago. It is not at all good that the United States and China are entering a period of reciprocal tariffs to damage the trade between those two and also the whole world. Once you start a trade war, basically the world economy suffers. Now, President Trump doesn't seem to recognize that, which is a major problem. So the negotiations of the Chinese in particular with the USA are based on threatening back the threat that Trump is making to the Chinese. It's all very disturbing, but I have to say the Chinese, whom I do not particularly admire, I do think that Trump has something right to say in observing that they have not followed the proper principles of recognizing the value of intellectual property. I learned that many years ago when I read the book by the Financial Times editor in Shanghai, who reported extensively on the copying that was going on. But the way to bring the Chinese to heel on this might be different from simply announcing a trade war. Now, the tariffs threatened by the United States against China, and then the reciprocal tariffs threatened by China to the United States if these first tariffs are actually made law, are the second round, actually, in the burgeoning trade war. Now, they are only mutual threats, and there's every chance they won't go through. And I certainly hope they do not go through, because it will be bad news for everybody in China, in the USA, and in the rest of the world, as everything adjusts and generally prices go up and inefficiencies come about and everything is going to go wrong. Now, the immediate impact on the stock market of this likely or probable or possible trade war is that stocks fell a lot. But there are other reasons for them falling, but in particular, the trade war threat was the prime mover downwards. I just have to mention that the tech stocks and the problem with Facebook are also part of the decline. Nevertheless, it is basically because investors know that a trade war is such bad news for the economy of every country. Well, as of the end of this week, there was a possibility that the Trump administration would understand that it's foolish to move forward. In other words, that the response to bullying is more bullying back, and maybe, just maybe, both sides will back off this foolishness. If they do, then we can be, as it were, back normal international trade and a stock market which is not too vulnerable to this issue. In fact, as I speak, the signs of them backing off mutually are growing, and that has caused the stock market to go back up again. So there's a real message they're getting through to President Trump, and I just hope he does listen to it, although obviously he is a very stubborn and determined person. Now, stock market investing is not too wonderful these days. There's great volatility. If you know how to trade in some way, I certainly don't, but trading, meaning buying and selling the stocks quite often, you can possibly make a lot of money in a volatile markets. But for most of us, we have neither the knowledge nor the time to make investment decisions about stocks on a regular basis. In fact, that's why I always stress with both my students in Robert Kennedy College and any listeners who care to take account of what I have to say, that putting your money into either managed funds or exchange-traded funds is an easier way to let your money give you some return. However, a new phenomenon is now asserting itself, which is this leveling off of the yield curve, first in the United States, but it will happen everywhere, where the central bank, the Fed in the USA, is raising the overnight rate, but the long end rate is not going up the way it would normally do if the economy were really taking off and inflation returning. In fact, it's not going up, and we have this leveling effect. And that means that if you buy bonds, you're better out on the long end, 7 years, 10 years, than you are the short end of a year or two or even a few months. And yet there is a point when the money market will reassert itself. There you need a bit of a historical perspective. People that have funds to invest would typically keep a reasonable chunk of those funds as short-term money, almost as cash. But there's nothing you can do with cash to get a return now, and that's been the case ever since for about 10 years now. So the money markets, which involved investing, say, for 3 months at a time, in Switzerland, you might remember they were called fiduciary deposits. Well, they became useless because the interest rates didn't even cover the charge of entering the market or not. Now, because the Fed is raising the short-term rates, and inevitably other central banks will follow, but it won't be for a few months yet, the money markets are in a way returning. It is possible in dollars now to actually have a positive return for very short investments, and that's fine. It's the 1 and 2 and 3 years which is dangerous, because those bonds are likely to fall in value as the Fed raises the rates, whereas if you've invested for only 3 months, it doesn't matter that the next 3 months might be able to give you a better return. So that's where I am in terms of certainly American securities. Better off increasing the proportion of bonds in your portfolio, but going at the long end, and allowing some of your investment cash to go into these returning money markets. We'll see if the famous fiduciary deposits come back in Switzerland. It won't be for a long time yet, because the interest rates in Switzerland are not going up anything like as much as in the USA, although they have bottomed out. They are gradually going back up again. Since things went wrong with my broadcast last week, most of you would not have heard my Easter greetings to you, so I can give you them again now and mention that it is Russian Orthodox Easter this Sunday. Speak to you again next week.